I want to show you two extremes. This first article says you should invest your CPF because there is a 100% chance that inflation will eat your purchasing power. Inflation, if it's 3.9% and your CPF earning 2.5%, that means your CPF value is dropping, correct? So this absolutely makes sense. But on the other hand, this article says that many CPF investors get their fingers burnt. Only 15% made profits larger than 2.5% and 40% made losses. 40%. Madness, correct? So I will circle back to this article and share with you the secrets on investing profitably, so stay on right to the very end. So today, without further ado, let me answer why usually you should be investing your CPF OA. So if you're curious on this topic, continue watching. Hi guys, welcome back. Let's quantify again the statement properly. I believe you should be investing your CPF OA, but not your CPF SA. And here's why. CPF SA gives you 4%, whereas CPF OA only gives you 2.5%. Although 4% seems a lot, it is still beatable in many ways. But this 4% is guaranteed. I get it. Guaranteed means that you can compound with certain projections very accurately, and there is no problems, especially when there's recessions or bad equity markets. So indeed, 4% is godsend. But the biggest problem of investing CPF SA is not regarding the 4% guaranteed rate, it's actually regarding the investment universe that you can buy using CPF SA. Take a look at this list over here of CPF SA approved funds. Right now, there are less than 20 names already. And if I'm not wrong, this list has been dwindling year on year. And what do we realize also? All of them on this list are either bond funds or balance funds. Balance means they have half bonds and half into equities. There are no pure equity funds. And that is the main problem, which I'll explain why. If we look in terms of a 2-year annualized return basis, you realize that indeed many can still beat 4% rate of return. In fact, the best performer, Schroder Multi-Asset, has done 12.05% per annum for the last 2 years. If you're curious why, inside the fact sheet, you can see that 30.5% is invested into US equities, which have done well in the last 2 years. So naturally, this fund has done well also. But back to this table, and beyond the 2-year rate of return, you realize that over the 5 years, it is also only the Schroder Multi-Asset that's beaten 4%. It's delivered 6.29%, which is slightly better than 4% over 5 years, but no one else has done so. So again, the problem with investing CPF SA is that the universe of funds are so limited, and the odds of doing better than 4% is just very slim. Having said that, this problem is not found in investing CPF OA, and I have data to back it up. In CPF OA, you can even buy gold, you can even buy Singapore stocks. Of course, these come with certain limits, so do be familiar with them. And before investing, do always note you need to do a self-assessment also. But CPF OA mainly can also buy equity funds, and some returns are pretty spectacular. So if you're ready for it, let me review to you the best performing CPF OA fund over the last 1 year. And these are the top 3 names. Allianz China Equity, JP Morgan China Equity, and Allianz China A-Shares Fund. All of them returning more than 50% over the last 1 year. 50%. So let that sink in a bit. And if we think about it, how many years of 2.5% do we need to achieve more than 50%? Maybe 20 years? And that's a long time versus 1 year rate of return. Or rephrasing it a bit differently from a different angle. How many losses can we absorb if one of the winners are 50% plus? We can absorb some losses, correct? And the overall investment journey, if it's diversified well, can still be a very rewarding one. You know, coming to here, I'm not saying invest and expect 50% rate of return. I'm also not saying go and buy China funds right now because they have been doing the best over the last 1 year. I'm not saying this. I'm saying that if you invest properly, beating 2.5% is not difficult. And sometimes you get lucky breaks, you get really big returns that will cover many years of underperformance and even some losses. So if you agree with that message, smash the like button because it's taken our team hours to prepare this presentation, and I really want to help more Singaporeans understand that if you invest properly, whether it's cash or CPF, you can build your wealth better, and that's what I wish for everybody. And if you'd like to continue learning on your journey, smash on subscribe also. I'll be releasing videos like this to help you in building up your wealth. So thank you very much, and let me move on to the next question that you might have. Hey Josh, this 1 year return is lucky. Can you show me data for a longer period or not? Can I really beat 2.5% comfortably? I am prepared for the answer, and let me show you this, which is 5-year return summary table, and the top 5 are right now doing fantastically well. All of these 5 have beaten S&P 500 returns, and investing in any of these 5 would have doubled your monies in just 5 years. Who are they? Not investment advice again, and don't go buying anything because of past performance. That's not how investment is done. Investment is always forward-looking. And if you're ready for the answers, let me show you. Number 1 on this list, Eastspring Japan Dynamic Fund with 24.1% per annum return. Amova Japan Dividend Equity, 19.08%. Lion Global Japan Equity, 17.05%. Japanese equities have been doing well. The bear market has ended over there, and I've personally allocated my equity growth portfolio for private clients, also with some portions into Japanese equity. Up next, Amova Singapore Equity, 16.21%. So Singapore equity is doing better than S&P 500 over the last 5 years. But again, this is a small segment period. And last but not least, rounding up the top 5 is Allianz Best Styles Global Equity Fund with 15.74%. Again, any of these will have doubled your monies in just 5 years. And speaking to here, maybe I have an extra spicy point to add. Are these returns better than property returns or not? Quite likely, yes, correct. But there's so many of us who would be not scared of investing 2 million into a property, but really concerned investing 2 million into equities, simply because of volatility. I'm here to share that if you can invest with a long-term horizon, equities can be a great place to build your wealth, which is what I'm personally doing for my own journey. So as always, if you have comments and questions, leave them in the comments sections below. In conclusion, I'd like to end up with a few points. Investing your CPF OA, not SA, is usually what I'll recommend. For private clients who have spare CPF OA above their property purchase, I usually do build portfolios for them also. So if you're keen to find out, look for my links below to reach me for one-to-one fee-based advisory work for retirement planning. And by properly investing, let's set some boundaries also. The first thing to note is the amounts that you can invest on CPF should not be what you need for any property in the next few years. Then you have real holding power, correct? Because equity markets are hard to say. Sometimes there could be a bear market and you need years to get back to a break-even point. The second is invest your idling cash first, because idling cash sometimes don't even get 2.5%. So deploy them first before deploying your CPF OA. The third is if you want to invest CPF OA, get into equities, not into bond funds, because you wouldn't be beating 2.5% comfortably over a long period of time. The fourth is invest at a pace that you're comfortable with. Something that you put aside and there's a bear market comes down, you can still sleep well. And this leads me to circle back to the article I shared at the start of this video. Why did some CPF investors get burnt? If you zoom down right to the bottom, there is a clue. As mentioned in the article, these investors lost despite good performance of investment funds, and as of 30th September 2015, 902,300 investors sold their CPFIS investment. So what happened in 2015? Very interesting. There were 4 major points. The first is Chinese equities actually fell 43% because of GDP slowing down. Chinese equities are super volatile, so they actually spiked up, ran up, and then came crashing down. The second was that there was a Greek debt default in that period. So a country defaulting is bad economic news. The third is that it was a period whereby US was exiting QE, which means a tightening of monetary policy. And as always, risky assets tend to suffer if monies become tighter. And the fourth is that there was noise of Brexit. 4 bad news. Looks like the perfect storm, correct? And it's no wonder the equity market sold down 10 or 15%. The secret again to making monies, whether you're investing cash or CPF OA, is that when there's bad periods, ignore all these bad news and survive. Survive these periods, don't sell, and you realize things will go back to all-time highs. In fact, if you want to make big monies, these bad periods are times to buy. If you are able to steady yourself, if you get the right advice and buy in these periods, you can make a lot of money. Think about it. hopefully inspires you to invest better. And as always, thank you for watching right then. I have these other videos that can help you in your investment journey, and I'll see you there too. Take care as always. Goodbye.